Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, May 6th, 2024. So instead of going through each economic variable that came out last week, I just want to do a recap of what investors are looking for or what we think the ingredients are for the equity markets here in the U.S. to continue to move upwards as it has so far year to date. So number one, corporate earnings have to be strong. So we'll go through that in a moment. Then we have really three factors that are interrelated. It's the same thing, but it's inflation, interest rates, and the Federal Reserve. And we have a data point on that from last week. And thirdly would be solid GDP growth, but not too fast to spur inflation. So we're going to talk about each of these and go through them just really quick. So in terms of GDP growth, we'll just do the last one first. GDP growth 2 weeks ago, less than 2 weeks ago, we had the first quarter GDP number that came out, and it was disappointing. Expectation was for the first quarter we would have about 2.5% growth. It came in surprisingly weak at 1.6% growth. So a lot of investors didn't like that. We personally, as a firm, we liked it. It's moderate growth. It still have growth, which is great, without inducing extra inflation. And the underlying 1.6% increase in GDP growth, 0.9% of GDP growth was shaved off by net exports. We were importing more than we exported, more than expected. So we thought the report was fine, but many investors kind of disagreed. But GDP growth, first quarter, solid growth without introducing additional inflationary pressure. So that's good. Then in terms of corporate earnings, so we're near the end of the earnings cycle for the first quarter. 80% of the S&P 500 have reported earnings. 77% of that 80% have announced earnings that were well in excess of what consensus estimates were. In fact, the average is 7.5% beat for those 77% of the companies. And most importantly, growth for the quarter, coming into the quarter, was expected to be 3.4% collectively for S&P 500 earnings. That now is up at 5%. So that's a pretty big increase, better than expectations. And so if we do come in at 5% growth for the first quarter, that would be the best S&P earnings growth that we've had now in a total of 7 quarters. Lastly, and this is the important one last week, inflation, interest rates, and what the Federal Reserve does. So last week, Jerome Powell, we had an FOMC meeting. Jerome Powell, the chairman, announced there was going to be no change, but what really got investors excited is that he said they weren't going to raise rates, which I'm a bit perplexed by because we watch the Fed funds future market closely, look at it every week, almost every week we report it to you, and there's never been any expectation of an increase built into the Fed funds future market. So I'm not sure who was worried about increases, but don't worry, Jerome Powell said they're not going to happen. So for some reason the market really liked that. Things went well last Wednesday. Then on Friday, this was the big news, and it's one of those bad news is good news. Non-farm payrolls came in much lower than expected. So for the last, certainly 2 years, employment numbers have have consistently beat expectations on a monthly basis. So coming into this month, the expectation was we were going to add almost 250,000 new jobs. Actual number, 175,000, which is fine in and of itself, but lower than expectations. But then the really good news under the cover, average hourly earnings were up, but less than expected. They were expected to be up 0.3% month over month, only up 0.2%, so that's good for inflation. Unemployment rate was a little bit higher than expected. It was expected at 3.8%, came in at 3.9%, and the average work week was reduced from expectations, was expected to come in 34.4 hours per week, came in 34.3. So between all that, the FOMC decision not to cut rates, but also making sure investors knew they weren't going to raise rates, the treasuries rallied dramatically at the end of last week. So the 2-year actually dropped 19 basis points during the week, and the 10-year for the week dropped 17 basis points. So what all of that rolls into then is GDP estimates for here, the second quarter, Atlanta Federal Reserve. I told you the first quarter GDP was only 1.6%. Atlanta Federal Reserve believes second quarter GDP is going to be 3.3%, and that came down dramatically from their expectation just a week ago, which is closer to 4%. But 3.3% GDP growth, I would actually say it's probably too strong if it comes in there because of potential inflation implications. So in terms of inflation expectations, we always take a look at the TIPS break even, and the 10-year expectation for inflation actually came down nicely last week, down to 2.35%. Now, we've seen an upward slope really almost since the beginning of the year. We were down under 2.2%, so it moved up to 2.4. Last week came back nicely, dropped 8 basis points down to 2.35% average for the next 10 years. Fed funds future market. This is post Jerome Powell's discussion on Wednesday. Fed funds future expectations for next FOMC meeting, which happens in June. There's a 92% probability of no cut, so the remainder 8% is for one cut. Now, looking at the end of the year, as we always do, what's the expectation? The odds of no cut at all by the end of the year, again, due to the Wednesday discussion by Jerome Powell, that dropped from 20% to 8.5% as the end of the day Friday, and then the odds of getting at least 2 rate cuts by the end of the year, that went up from 62% from 40% the week before. So investors are excited, back on board, thinking Fed is going to be cutting sooner than later. So wrap all that up, what happened with the markets based on that last week? Now, prior to last week, we had 3 weeks in a row where equities were weak here in the U.S. Given the news that we had last week, equities rebounded. So S&P 500 up about 0.6%, really led by the NASDAQ up 1.4%. And surprisingly, and good for us, small cap strong last week up 1.1%. So now, year to date, S&P is up 8%, and the NASDAQ is up 7.63%. So we haven't seen that in a while. So we are getting that rotation away from just large cap tech to other areas of the market, which is good. We think healthy longer term. So international markets last week ended up beating the U.S. This happened a couple of times in the last couple of months, and this happened very infrequently last year. But developed markets ex-U.S. up 1.3%. Again, S&P 500 up about 0.6%, but emerging markets up 1.9%. And below that, what really drove it, China, about 25% of that index. China equities up 4.2% last week, and year to date now is beating the S&P up 8.6%. On the fixed income side, so we talked about, I mentioned the fact the 2 and the 10-year dropped dramatically in terms of yield, which means value goes up. Last week, the Bloomberg U.S. Aggregate Bond Index up about 1.2%. So that cut into the losses that we've seen year to date. So now the year-to-date loss on the Bloomberg U.S. Aggregate Bond Index is about 2%, 2.1%. So that's it for last week. This week, unlike last week, appears to be very calm in terms of economic data points. We have jobless claims. We have that every week. Expectation is 210,000. Prior week was 208. That generally doesn't move the market unless there's a huge outlier event. So we'll dismiss that. So the only indicator of consequence this week, University of Michigan will come out with their preliminary consumer sentiment index for May. Last month that was at 77.2. It's expected to come in line with that, called 77.0. So that's it for the recap from last week, preview of this week. Thank you very much for your attendance. We'll look forward to seeing you next week. Thank you.